Hello and welcome to Charting Points, a technical look at ag markets. My name is Brian Como. Today is October the 31st. It has been a bit of a scary day in the markets today, so let's go through what's going on today. First, I'm going to read you this disclaimer. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties express or implied as to the accuracy or completeness of the statements or any information contained in the material, and any liability, therefore, is expressly disclaimed. Past results are not necessarily indicative of future results. All right, we're going to talk about, I'm going to get into the Canadian commodities here a little bit before going into some of the broader commodities. First here, looking at January canola. Now, it's been a really wild ride this week. We've seen days where it starts off higher, ends up lower, days where it starts off lower, ends up higher. It's just kind of been a bit of a choppy mess here this week. This is the kind of what I'm referring to in here. Now, what's concerning today is a couple of different things. First of all, a new low today. This occurred as we moved towards the close. So in the dying minutes of the market, we moved to a new low under 680. That was kind of a bit of a support level, psychological support level that we were watching. That's a bearish input. The November has sunk out quite a bit more, and this is generally a bearish chart. So I originally just wanted to put that out there because I didn't want anybody to think that that we were working under the assumption that this is going to turn over anytime soon or anything like that. At this point, this is still a bearish looking chart. Another thing I want you to pay attention to here is this cross that's going to happen. This purple line here is the 50-day moving average. This green line here is the 200-day moving average. Now, that the cross, when a 50-day crosses to the downside of the 200-day, that is what we call the death cross. And that is a bearish input, a bearish signal. Just so you don't think I'm making that up, this is right out of the Investopedia website here. Watch closely when something trades, when the 50-day trades over the 200-day. Now, this comes again from Investopedia, which focuses largely on equities, but it is the same principle, and that is what is going to happen. Didn't happen here today, but it's very close, 30 cents, right? So the momentum here, regardless of what happens tomorrow, we're going to see this death cross tomorrow. So that is a longer-term bearish input or a longer-term bearish technical signal in this market. Don't want to ignore that. You may be asking, well, if you're so bearish and this chart looks so bearish, why aren't we selling? And, in hindsight, it would be nice to be able to make recommendations and then peel them back once the market starts to bottom and turn over. But we generally don't have that flexibility. We like to just make the recommendation and then move forward after that. As a result, we're still at 50% recommended. I think some of the anxiety that's coming from the market today might be because there are folks that are below that level. There are ways that you can get comfortable in this market as well. I just got off a call where we were talking about using minimum pricing strategies if you're in the uncomfortable area to make sure that your profits are hedged. If you are in an undersold area at this point in time, would recommend getting into that 50%. I feel like you might feel more comfortable if you are in there anyway. I do think that this market is due for a bounce. This time of year is a terrible time of year to sell. We like to stand aside. All of the recommendations that we made prior to this time frame were designed in order to be able to and were comfortable to step aside. So that is one thing that talk to your advisor about, because this is a very individual situation. I can't sit here from my 30,000 foot view and tell you what's perfect for your farm. That is where your advisor comes in, and I would highly recommend having that conversation with them to figure out where that number is. For some people, that number might be 60%, might be 70%. For some people, maybe where they're at, 30, 40, 50 might be comfortable, and they are okay waiting for the bounce to sell into if there is one going to come. I do feel that there is going to be a counter trend move here, and we will want to take action once that counter trend move occurs. because this market is increasingly looking long-term bearish, but is due for a bit of a corrective move to the upside. Couple of things here. This is also a bit of a bearish technical or market structure here, is that this is the forward curve on canola. And so there's some, larger carries being built into this market now. So if you are in one of those areas where you do want to add some sales, but maybe you don't need the cash, you don't need the movement, there is incentive right now in the futures market to carry that out as we move through March and May and July. Also gives you a lot of opportunity to kind of play around with OTC contracts in the market if you want to use a re-entry strategy if the market turns around. So using the carry to your advantage in this market is a smart idea. And if you are looking at making some sales and you don't need the movement or the cash flow right away, I would highly consider looking at the forward curve and selling upward somewhere on the forward curve because it does give you more opportunity. And if this market does continue to trend into a bearish type of situation, what happens in a contango market like this is that these forward months tend to gravitate back down towards the this is the January here. So this kind of front month style is where it gravitates to. That's why an inverted curve, it's the opposite, right? The prices tend to lift up towards the front month. In a carry market like this, the prices tend to contract into the front month contract as well. Also, if you're looking to make money in this market, I would highly suggest selling these kinds of caps. I think that's a really great way to make some extra cash in this canola market as well. All right, getting back into the serious note here. On a positive note, here is canola board crush margins. Again, I think that's why seasonality is important, or at least being able to sidestep weakness is important. As you can see, this weakness has created an opportunity here in the crush market where crush margins are really attractive. They are less so as you move out towards March and May, but they still are growing in those months. And actually, I think that this is a bit of a better situation anyway. When the Jan crush margin grows faster than the forward months, it means that there will likely be some more business captured in the Jan to capture that extra few dollars of margin. And that could help us out as we move into December, or even as we move through January. So I do think this is a positive potential piece of the canola market. All right, looking at Canadian wheat here, I did kind of post this chart on Twitter talking about like the great Canadian wheat divergence. This yellow line here, this is the Canadian FOB cash prices for wheat. This is in US dollars, so it does not have the FX factor worked into it. As you can see, most of these markets here, this blue one here is US Gulf. This red is Australia. Higher protein, and then this green is Russia 12.5 protein, just as a kind of a check. We've been talking about how these prices in Russia have been pressuring wheat markets. That is true. It is continuing to keep pressure on the markets, but as you can see, Canada is diverging to some degree, and I think some of that has to do with the quality, some of that has to do with the availability, and you're probably wondering, well, why is my price going down when the price of FOB is going up? Here's a bit of a closer zoomed in version of that. So here's, again, here's Russia in green here in this chart, and Gulf, HRW, US, and then here's Canada. So it's not like it's a meteoric rise or anything. It's more of a gradual grind higher. But it does look kind of funny when you look at Minneapolis wheat and how today Minneapolis wheat made a new low today. So this would be, technically a bearish input. Anytime you make a new low, that would be a signal to sell. There isn't really anything on this chart that looks bullish either. So, what's happening in Canada? So, just to kind of illustrate what's happening with prices, this is a chart from PDQ, or the Alberta Wheat Commission. They do a good job of tracking kind of averaged prices. They don't necessarily, put in the best prices in there. They don't necessarily include premiums that aren't included on the website and that are only given to, special areas or special months or something like that. But what I find with these charts is that they give you a good indication as to the directionality of where things are going. And as you can see through the month of October, we've actually been pretty stable on cash wheat values. So that means that as the futures are falling, something is keeping the wheat prices elevated in Canada. Now, one of those things here is the Canadian dollar. Today, we made new lows in the Canadian dollar. It traded below 72 cents for a period of time. We have a bank of, or the Federal Open Market Committee reporting tomorrow afternoon with U.S. interest rates. I know the U.S. dollar and the yen the U.S. dollar has gained a significant amount of value against the yen recently. The dollar index is rising a little bit as well, but Canadian dollar is definitely taking a beating. A little bit of that has to do with kind of energy prices. I'll show you a chart of that later. But this is, the Canadian dollar is having a positive effect on wheat values. This is what basis looks like for Canadian Western White Spring. This is the same. So kind of working off the same areas here. This again is the kind of the Yellowhead corridor of Alberta, which also includes parts of Saskatchewan, including North Battleford and that kind of area. So this is what's happening with basis. So as you can see, basis is rising. This is not all about the Canadian dollar. The Canadian dollar would be a portion of this. But what we are also seeing is, lack of farmer selling means that elevator companies need to get creative on how they incentivize delivery. When futures are rallying, it's relatively easy. When they're falling like they are, it's much more difficult. So we're seeing basis levels for wheat rise extremely high. And that is what is kind of keeping that Canadian wheat price relatively stable. I was kind of doing some calculations, and I'm not going to put these calculations on the board because I'm not confident in the numbers, and I don't have access to actual freight rate numbers here. But this is a freight rate rail services pricing index, and I have quarantined off just the agriculture components, which would be grains, oilseeds, and fertilizers. And this is kind of what this is August here. The index, and then this is September, and then this is October right here. So you could see that the rail freight has actually increased in value quite considerably as well. So one thing we want to keep in mind is when we look at these prices and we kind of see them moving higher here over time, some of that is rail freight. It's not just that end users are buying higher and the elevator companies are not passing that down to the farmer. I think that the pricing moving higher is helping also keep those cash values relatively stable in a falling futures market. But all of this together is kind of creating this environment where we aren't seeing the losses in the cash market in wheat in Canada, largely because of a couple of different things. One, the FOB prices are rising. Two, basis levels are rising, also independent of currency, although currency is part of it, and the third would just be lower farmer selling and looking for incentives to deliver wheat. So that's kind of the story. I know it's not a very comprehensive story, and it's very, very convoluted. It's hard to really break down which of these inputs are making the biggest impact. I think they're all making some kind of impact. But overall, FOB values are rising, but so are freight rates. Basis values to farmers are rising, and futures are falling. And all of that kind of mixed together has created kind of this stability in the hard red spring wheat market. At some point, something's got to give, and if we see a turnaround in futures values, I think we could see some increase in value. But if the market is going to capitulate towards the futures market, then we could see cash losses in this market as well. So just be aware of both of those scenarios. Again, it's a similar situation. We're standing aside. This is traditionally a time when it's a poor decision to make big marketing decisions on any commodity, particularly with the big harvest coming off in the U.S. So we are standing down and hoping that the sales that were made prior to harvest are carrying you through as far as cash and movement needs and things like that. One other input about U.S. wheat, and this is I understand this is a poor chart, but I just kind of yanked it off public sites today. U.S. winter wheat conditions were 40, I think it was 48% good to excellent as it came into the first rating of the year. That's the best it's been since 2019, I believe that is. So good conditions for U.S. winter wheat. That put some pressure, particularly on Kansas today. And as you can see, Kansas kind of sunk even further into new low territory here. When you look at where Kansas could be headed here, this is the monthly continuous. It's trading, 630 right now on the front month. There isn't really much support until you get, 550, 560. That's a real threat for this Kansas market, particularly if the winter wheat crop continues to look good. Here is January. I'm going to show a couple of charts. These are mostly, I would call, neutral at this point. So the row crops in the U.S. Here's January soybeans. Haven't seen any kind of major technical indicators here in the last, week or so. We're kind of working inside of a tight range in that 13 to 1335 range here. Outside of that, we have kind of a 1265 on the top side. And, this range is pretty close to where those highs would be on the outside range as well. Again, harvest pressure in the U.S. Harvest is ahead of average. This is putting some pressure in the marketplace as well. Just to kind of update you on the soy meal situation, we left Friday with reaching new highs in the soy meal market. We've seen it come off a little bit into Monday. Today, a little bit of a bounce. This market still looks very strong, but the major meteoric rise, unless it's going to continue to push higher, which is possible, may be in, but this chart continues to look bullish. And as you can see, these moving averages here, the 20-day moving average just blew through all of the other moving averages, moving it well outside of what we would call neutral territory. And so, what we may be seeing here is some consolidation before the next move higher. It's not like the Argentinian situation is going to correct itself in the next few weeks or so. So just kind of juxtaposing that with bean oil. Bean oil has been weak. It did sink to closer to previous lows today. It's still on the trajectory downward. This is one of those things that is also having a negative impact on canola. And so just want to be aware of that. The two commodities are working outside or in opposite of each other as far as bean oil and bean meal go right now, but neither of them are making any new highs or new lows after the trend moves that we saw last week. Here's corn. It's kind of the same thing. We saw it run up above $5. It sunk. We're in a very tight range here now, between 475 and call it 485. I think there's a high probability chance that we'll come back down and trade into this 470 area. If it breaks below that, there could be some further weakness. I would say, as far as a bounce is concerned, this one, corn is probably the one that we feel has the least amount of opportunity to make a major comeback after harvest. The fundamentals are significantly different in corn than they are for beans. And so we want to treat this one with a little bit of kid gloves as well. And right now it's behaving in a neutral fashion, but that could change as we go forward. Another chart we want to keep an eye on here is oats. December oats kind of made about a 14-cent decline today. Not exactly sure what was pushing that lower, but we are seeing, a potential moving average cross here between the 20 and the 200. That would continue to create some momentum to the downside for oats. Again, as far as Canadian cash prices go, we haven't seen as major of a decline, but again, cash prices can only withstand so much futures weakness. I think if it holds that, this kind of 370 support, we're probably okay. But if we start to see further declines past that, then there could be some risk for further downside to cash prices in Canada. Just some outside market charts here. Again, this is another potential veg oil input. We saw crude sink to a new low today, down to 81. As you can see, this is October the 6th, this previous low here. This October 7th was the gap higher after the attack. We're well below those levels now. So risk premium as a result of the conflict is not playing a role in crude oil any longer. That's probably also one of the reasons why we saw the Canadian dollar sink today. So there is a bit of a petrol currency trade happening in the Canadian dollar as well. Here's the US dollar, a bit of a surge today, engulfing candle to some degree. Tomorrow the Fed speaks, so it's really kind of anyone's guess here what happens in this market. It could have been pricing in. I mean, the Fed is expected to stay on rates, but the accompanying statement is usually what rallies or what riles up the market. Pretty big trading range today in the US dollar, but didn't move to anywhere where it hasn't been in the last week or so. So nothing really to report there. Just wanted to make you aware ahead of the FOMC today. All right, that's all we have for you today. Thank you for joining us, and we will see you again next time. This closes out October. We'll see you in November.